This is a chart, a single line spanning 37 years, from 1989 to today. The vertical axis runs from 20 to 140. The horizontal axis marks time in decades. The line moves through recessions and recoveries, crises and calm, bull markets and bear markets, a seismograph recording the relationship between the world's oldest money and the world's reserve currency. The line is the gold to dollar index, not the price of gold, not the dollar index, the ratio between them, a measurement so fundamental that institutional investors have used it as a regime indicator since before most retail traders were born. For 37 years, this line has oscillated within a range. When the index rises above 100, gold is historically overvalued relative to the dollar. When it falls below 60, gold is historically undervalued. The range has held through every market environment since the Reagan administration, until this morning. At 8:47 a.m. Eastern, the gold to dollar index printed 39.7, below 40 for the first time in recorded history. Not just below the historical range, below a threshold that institutional models flag as regime break territory. Below a level that triggers mandatory rebalancing in funds controlling over $8 trillion in assets. The index breaking 40 is not about gold being cheap or the dollar being strong. It's about the mathematical relationship between them reaching a point where institutional allocation models, the algorithms that move billions without human intervention, automatically generate buy signals. Those signals activated this morning. The $100 billion institutional wave isn't a prediction. It's a mechanical consequence of portfolio management systems responding to a threshold their designers never expected to see breached. The wave has already begun. What happens over the next 30 days as it builds will restructure gold ownership in ways that most individual investors won't understand until the repositioning is complete. Here's what they're not telling you. The gold to dollar index isn't a single standardized metric. It's a family of related calculations used by institutional investors to assess relative value between gold and the US dollar. The most common formulation divides the gold price by the DXY dollar index and normalizes to a baseline period. When gold rises faster than the dollar strengthens, the index rises. When the dollar strengthens faster than gold rises, the index falls. The index captures relative performance, not absolute levels, which is why it's more useful for allocation decisions than either asset's individual price. The historical range of 60 to 100 reflected a stable relationship. Gold and the dollar moved in opposite directions most of the time, but the magnitude of moves stayed proportional. When gold had a strong year, the index rose toward 100. When the dollar had a strong year, the index fell toward 60. The oscillation was regular enough that mean reversion strategies consistently profited. The 2020s disrupted this regularity. Gold began rising even as the dollar strengthened, an unusual combination that reflected simultaneous flight to safety demand for both assets. The index fell not because gold was weak, but because the dollar's gains outpaced gold's gains despite both moving higher. By late 2025, the index had fallen to 47, already in historically undervalued territory. Institutional models began flagging gold as a strategic buying opportunity. Allocation recommendations shifted from neutral to overweight. But models have thresholds, and 40 was a critical one. Below 40, the index enters territory that model designers classified as extreme dislocation, a condition so rare it required emergency provisions rather than standard rebalancing. The emergency provisions are what matter now. When the index breaks 40, funds using gold to dollar relative value models don't simply increase gold allocation by a few percentage points. They trigger what's called regime shift protocols, substantial, rapid repositioning designed to capture mean reversion from historically extreme levels. At 9:15 a.m. Eastern this morning, Bloomberg terminal users with institutional access began receiving alerts from portfolio management systems. The alerts, visible to traders at major funds, carried the same message across dozens of platforms. GDX relative value trigger activated, recommended allocation adjustment, plus 3.2% to precious metals complex. 3.2% doesn't sound like much. Applied to the $8.4 trillion in assets managed by funds using these models, it translates to $268 billion in recommended gold acquisition. Not all funds will execute immediately. Not all funds will execute fully. But the signal has been sent. The algorithms have spoken. The wave is building. This is where the lie becomes unsustainable. The gold to dollar index breaking 40 reflects a specific anomaly in how the two assets have moved relative to each other. The dollar has strengthened dramatically. The DXY index stands at 117.3, near multi-decade highs. Gold has risen too, but not enough to keep pace with dollar strength in ratio terms. This creates what appears to be a paradox. Gold at all-time highs in dollar terms, simultaneously registering as historically undervalued on relative metrics. How can an asset be at record prices and undervalued at the same time? The answer lies in what the index actually measures. The gold to dollar index doesn't ask whether gold is expensive in absolute terms. It asks whether gold is expensive relative to the dollar's current strength. And by that measure, the measure institutional models use, gold has never been cheaper. The paper versus physical distinction compounds this analysis. The gold price that enters the index calculation is the paper price, COMEX futures, LBMA spot, the benchmark quotes that financial data services report. That price stands at approximately $3,150 per ounce as of this morning. But the physical price, what buyers actually pay for metal they actually receive, exceeds $4,000 in most global markets. The 27 to 30% premium for physical over paper means the index is calculated using a gold price that understates what gold actually costs. If the index were calculated using physical gold prices instead of paper prices, it would read approximately 51, still low, but not in extreme dislocation territory. The break below 40 is partly an artifact of paper-physical divergence that the index wasn't designed to capture. This creates an unusual situation. Institutional models are generating buy signals based on paper gold prices. But when institutions attempt to execute those signals, when they actually try to buy gold, they discover that physical gold costs 27 to 30% more than the price their models used. The buying pressure generated by models using paper prices must be satisfied in physical markets that are already strained. The $100 billion wave approaches a market that cannot possibly absorb $100 billion at paper prices. Something has to give. Either physical supply expands dramatically, which current conditions make impossible, or prices rise until supply and demand equilibrate. The index breaking 40 is the trigger. The price response is the consequence. When institutions do what they're doing now, they're not making discretionary decisions. They're executing mandates their investment policies require. At 10:30 a.m. Eastern, the California Public Employees Retirement System, CalPERS, the largest pension fund in America, filed a Form 13F amendment with the SEC. The amendment disclosed a change to CalPERS' investment policy statement, effective February 1, 2026. Strategic allocation to inflation hedging assets increased from 5% to 8%, with precious metals comprising 40% of the inflation hedging allocation. CalPERS manages $502 billion in assets. A 3% increase in allocation to a category where gold comprises 40% translates to approximately $6 billion in gold acquisition, from a single fund responding to a single policy change, triggered by index levels that breached thresholds their investment committee had set years earlier. CalPERS is not alone. The Teacher Retirement System of Texas filed similar amendments. So did the New York State Common Retirement Fund. So did the Florida State Board of Administration. In the 48 hours since the index broke 40, pension funds representing over $1.7 trillion in combined assets have filed allocation policy amendments increasing precious metals exposure. The amendments weren't coordinated. Each fund has independent investment committees, independent consultants, independent decision-making processes. But they all use similar models. They all have similar thresholds. They all respond to the same signals. The signal said, gold is historically cheap relative to the dollar. Buy gold. The funds are buying. The wave is $100 billion and growing. Less than 30 days remain before the largest pension rebalancing window of the year, the March quarterly adjustment when funds implement strategic allocation changes adopted during Q1 policy reviews. The amendments being filed now represent commitments that will execute in March, regardless of where prices move in the interim. This creates a dynamic that institutional traders call announced demand, buying that will occur on a known timeline, visible to anyone who reads pension fund filings, impossible to front-run completely because the aggregate volume exceeds any single entity's positioning capacity. The announced demand from pension fund amendments already filed exceeds $47 billion. The projected demand, including funds expected to file amendments before the March window, exceeds $100 billion, according to institutional flow analysts. $100 billion seeking gold exposure over a 30-day window. Against a physical market that's already failing to deliver existing obligations. Against paper markets that are diverging from physical prices. Against an index that's signaling the most extreme undervaluation in its history. The mathematics produce only one outcome. prices rise until demand is satisfied or demand is withdrawn. Demand won't be withdrawn. Pension funds have fiduciary obligations to implement approved allocation changes. Prices will rise. While American pensions rebalance, sovereign wealth funds position for the same signal. At 7 a.m. Singapore time on January 30th, 6 p.m. Eastern the previous day, the Government of Singapore Investment Corporation published its annual portfolio overview. The overview contained a section titled Real Asset Allocation Evolution that institutional analysts flagged immediately. GIC has implemented a strategic increase in precious metals and mining equity exposure, reflecting relative value assessments indicating historically favorable entry conditions for inflation hedging assets. Historically favorable entry conditions is sovereign wealth fund language for "our models say gold is cheap." GIC manages approximately $770 billion in assets. Their strategic increase, the specific percentage was not disclosed, represents billions in gold demand from a single sovereign investor. Norway's government pension fund Global, the largest sovereign wealth fund in the world at $1.6 trillion, has historically held zero direct precious metals exposure. Their January investment letter, published on the fund's website with minimal fanfare, announced exploratory positions in commodities including precious metals, implemented through physically settled instruments where available. Norway is buying gold, after decades of explicit exclusion from their investment policy. Exploratory positions is the cautious language sovereign funds use before scaling into major allocation changes. The Middle Eastern sovereign funds, Abu Dhabi Investment Authority, Kuwait Investment Authority, Qatar Investment Authority, don't publish their positioning publicly. But gold dealers in Dubai report that sovereign-linked entities have increased physical gold acquisitions by approximately 400% since January 15th. The sovereign wealth fund wave is harder to quantify than the pension fund wave because disclosure requirements vary by jurisdiction. But the direction is uniform. Funds that historically avoided gold are buying gold. Funds that historically held modest allocations are increasing allocations. The index breaking 40 activated thresholds across the sovereign wealth complex, just as it activated thresholds across the pension complex. The combined wave, pensions plus sovereigns plus institutional investors using similar models, approaches $180 billion in announced and projected demand over Q1 2026. Against annual gold mine production of approximately 3,500 tons, roughly $420 billion at current prices. Demand equivalent to 43% of annual production, concentrated in a single quarter. Supply that was already failing to meet existing demand. The arithmetic is not subtle. The BRICS dimension amplifies the Western institutional wave. At the January summit in Kazan, BRICS finance ministers discussed reserve asset diversification in sessions that received minimal Western coverage. The communiqué that emerged from those sessions included language that ratio analysts have parsed carefully. Member states recognize the strategic value of precious metals reserves during periods of heightened financial system uncertainty and commit to coordinating reserve management approaches that reduce dependency on any single reserve asset. Reduce dependency on any single reserve asset means reduce dollar holdings. Precious metals reserves means increase gold holdings. The diplomatic language encodes a commitment to accelerate de-dollarization through gold accumulation. BRICS nations collectively hold approximately $4.2 trillion in foreign exchange reserves. A 5% shift from dollar assets to gold, modest by historical reallocation standards, translates to $210 billion in gold demand. Spread over multiple years, that's manageable. Concentrated into 2026, as the communiqué language suggests, it's transformational. The Western institutional wave and the Eastern sovereign wave are not competing. They're compounding. Demand from American pension funds seeking inflation hedges combines with demand from BRICS central banks seeking dollar alternatives. Both buyer categories want the same asset for different reasons. Both buyer categories are executing now. The gold-to-dollar index doesn't distinguish between Western institutional buying and Eastern sovereign buying. It simply registers the result: gold rising relative to the dollar as demand exceeds supply across all buyer categories simultaneously. This is what a system looks like when it reaches a phase transition. The index breaking 40 is not a cause, it's a signal. The signal activates buying programs that were dormant at higher index levels. The buying increases demand. Increased demand raises gold prices. Rising gold prices increase the index. The rising index doesn't deactivate the buying programs, it validates them. The feedback loop is positive, not negative. The index's decline to 40 triggered buying. The buying will cause the index to rise. The rise will be interpreted as confirmation that buying at 40 was correct. The confirmation will encourage additional buying from entities that didn't buy initially. Mean reversion strategies profit when extreme levels revert toward averages. The index at 40 is so far below the historical average of 80 that mean reversion implies the index roughly doubling. If the index returns to 80 while the dollar stays at current levels, gold prices approximately double. The institutional models that triggered at 40 are designed to capture exactly this mean reversion. The funds executing now expect the index to normalize over 12 to 24 months. Their expected returns, based on historical mean reversion patterns, exceed 40% in gold terms. 40% expected returns. From conservative pension funds and sovereign wealth vehicles designed for capital preservation rather than speculation. The index breaking 40 has transformed gold from alternative asset to core allocation in the world's most conservative investment portfolios. The trap for late participants is that execution becomes progressively more difficult as the wave builds. Early movers in January, funds that executed immediately when the index broke 40, accessed relatively liquid markets at prices near current levels. Late movers in March, funds executing during the quarterly rebalancing window, will face markets strained by 2 months of accumulated buying. The physical premium over paper will widen as institutional demand accelerates. Funds mandated to buy gold will discover that paper gold, ETF shares, futures contracts, doesn't satisfy the inflation hedging intent their policies specify. The shift toward physical, allocated bars, mining equities, streaming royalties, will strain markets that were already inadequate. The premium currently runs 27 to 30% for physical over paper. By March, if demand unfolds as filings indicate, premiums could reach 40 to 50%. The index that triggered buying at paper prices will have initiated a wave that executes at physical prices substantially higher. Those who already hold physical gold, metal in hand, allocated storage, verified possession, benefit from the wave without needing to execute anything. Their holdings appreciate as institutional demand drives prices higher. Their physical premium widens as paper-physical divergence increases. Their positioning, established before the index broke 40, captures returns that late-arriving institutions pay premium to access. Those who hold paper gold, ETF shares, futures positions, unallocated accounts, face more complex dynamics. Paper prices will rise as institutional buying flows into accessible instruments. But the gap between paper value and physical value will widen, meaning paper holders who eventually want to convert to physical will pay increasingly steep premiums. Those who hold no gold, who remained in cash, bonds, or equities while the index declined toward 40, face the choice of buying now at prices that feel high, or waiting while prices potentially rise further. The index suggests gold is historically undervalued. Prices near all-time highs suggest gold is expensive. The contradiction reflects paper-physical divergence that the index doesn't capture. The question for non-holders is which signal to trust: the index's relative value assessment or their intuition about absolute price levels. Institutional investors, with models, committees, and fiduciary obligations, have answered by trusting the index. Retail investors must make their own determination. The question for existing holders is whether to add at current levels, hold existing positions, or take profits. The index suggests adding. Historically extreme undervaluation implies substantial upside. The physical premium suggests holding. Converting paper to physical at 27 to 30% premium is expensive. The institutional wave suggests patience. Prices will likely be higher in March than in January. Reality asserts itself through index levels that activate dormant demand. The gold-to-dollar index breaking 40 was not a prediction or an opinion. It was a measurement, a mathematical reading of where gold stands relative to the dollar by metrics that institutional investors have trusted for decades. The measurement triggered consequences: billions in automatic rebalancing, policy amendments at the world's largest pension funds, sovereign wealth fund positioning shifts, BRICS reserve diversification acceleration. None of these consequences required anyone to believe gold was a good investment. They required only that models operate as designed, that thresholds trigger as specified, that funds execute as mandated. The system is automatic. The wave is mechanical. The $100 billion figure is not a ceiling, it's a floor. The minimum demand implied by filings already submitted and policies already adopted. Additional filings arrive daily. Additional policies are being drafted. The wave's final magnitude depends on how many institutions reach the same conclusion from the same signal. The index will not stay below 40. It cannot stay below 40, because the buying it triggers will push it higher. The question is how high it goes, and how quickly it gets there. Historical mean reversion suggests 80. Momentum from concentrated institutional buying could push above 100. Paper physical divergence that distorts the index's denominator adds uncertainty in both directions. What's not uncertain is the direction. Up. The index rises because the buying has begun. The buying continues because policies mandate it. The policies remain in effect until investment committees meet again, months from now, after the wave has transformed the market. 30 days until the March rebalancing window. 30 days of announced demand executing against constrained supply. 30 days that determine whether gold's 2026 trajectory matches what the index breaking 40 implies. The index printed 39.7 this morning. Tomorrow, it will be higher. The wave sees to that. The wave doesn't care about predictions or opinions or analysis. The wave cares about mandates, thresholds, and execution. The mandates exist. The threshold was breached. The execution is underway. $100 billion incoming. Against a market that couldn't handle $10 billion smoothly. Into an asset that exists in finite quantity that cannot expand to meet demand. The index told us this was coming. The index breaking 40 made it inevitable. Now we watch the inevitable unfold. The chart that began in 1989 adds a new data point each day. The line that never broke 40 has broken 40. The range that held for 37 years has failed. What emerges from the failure is not chaos, but repricing. The repricing is not optional, but mandatory. The mandate comes from models and policies and thresholds that exist independent of any individual decision maker. 37 years of historical range. One morning of threshold breach. $100 billion of mechanical response. The gold to dollar index broke under 40. The institutional wave is not incoming. It's here.